Good morning. This is Global Markets Daily Brief. I am Jonathan Simkowitz. Today is Saturday, February 28, 2026. The headline today is War. The United States and Israel have launched joint military strikes against Iran. But the capital allocation question underneath this headline is not about the strikes themselves. It is about the Strait of Hormuz. Because if you are running a portfolio right now, the thing you need to price is not the probability of bombs falling on Tehran. That is already happening. The thing you need to price is whether roughly 20 million barrels of oil per day continue to flow through a 39-kilometer-wide corridor that sits directly inside a theater of active military operations. That distinction matters enormously. Here is what happened. In the early hours of Saturday morning Eastern Time, the United States initiated what the Pentagon is calling Operation Epic Fury. Israel launched a coordinated campaign under the name Roaring Lion. Strikes have hit Tehran, Isfahan, Qum, Karaj, and Kermanshah. Targets include military and nuclear infrastructure, missile production facilities, and, according to multiple officials, the offices and residences of Iran's senior leadership, including Ayatollah Khamenei himself. Iran's foreign minister, Abbas Araghchi, confirmed to NBC News that the supreme leader and president are alive, but he acknowledged Iran may have lost one or two military commanders. Israel has declared a state of emergency and closed its airspace. Civilians are sheltering in place. Iran retaliated quickly and broadly. Dozens of ballistic missiles were launched at Israel and at American military installations across the Gulf. U.S. bases in Qatar, Bahrain, Kuwait, the UAE, and Jordan all came under fire. One person was killed by missile debris in Abu Dhabi. Qatar confirmed intercepting 2 Iranian missiles over its territory. The Houthis announced they would resume attacks in the Red Sea. The scale and the geography of this retaliation is significant. This is not a contained bilateral exchange. Iran has struck across 6 countries. Markets absorbed the buildup into Friday's close. Brent crude settled up roughly 3% at around $73 a barrel. West Texas Intermediate closed near 67. The S&P 500 finished Friday down about 0.5% at 68.79. Already under pressure from a hot inflation print. The VIX jumped more than 11% to settle above 20. That is the first-order reaction. Let's step back. Here is what consensus believes right now. Most desks expect a short, sharp oil spike when Asian commodity markets reopen Sunday evening. The range being quoted is $3 to $5 per barrel on Brent, possibly more. Several analysts project Brent touching $80 in the initial reaction. The base assumption embedded in that range is that the Strait of Hormuz stays open, that Iranian oil exports of roughly 1.9 million barrels per day are disrupted but replaceable, and that Saudi Arabia and the UAE have enough spare capacity to cover the gap. That distinction matters enormously. Here is what I believe markets are underpricing right now. First, duration. President Trump described this as a major combat operation. Prime Minister Netanyahu said strikes would continue as long as needed. A person briefed on the operation told NPR it was expected to last several days, with Israel focusing on destroying Iran's missile program. But the stated U.S. objective is regime change. Trump explicitly called on Iranians to take over their government. If you are modeling a 72-hour precision strike, you get one oil price path. If you are modeling a weeks-long campaign with regime change ambitions, you get a very different one. The market is pricing the former. The rhetoric suggests the latter. Second, the Strait of Hormuz. Iran has not attempted to close it, but Iran's parliament voted last June to support closure. The IRGC conducted live fire drills in the strait just 11 days ago and temporarily shut parts of it down. A senior IRGC commander stated publicly that the order to close it could come at any time. Iran would be hurting itself since it ships its own crude through the strait, but if the regime concludes it faces existential destruction, the calculus changes. The strait has never been closed during a Middle East conflict. That historical precedent gives markets comfort. But we've also never had a joint U.S.-Israeli operation explicitly targeting Iran's supreme leader while simultaneously hitting its nuclear and missile infrastructure. The precedent set may not be the precedent relevant. Third, the geographic breadth of retaliation. Iran did not just fire at Israel. It fired at American installations in 6 Gulf states. Saudi Arabia confirmed it was hit. Greece has advised its flagged vessels to avoid the entire Arabian Gulf, the Gulf of Oman, and the Strait of Hormuz. the UK Maritime Trade Operations Agency is advising ships to transit with extreme caution. Shipping insurance rates are about to reprice. Even without a formal blockade, if tanker operators begin rerouting or pausing, the effective throughput of the strait drops. You don't need a blockade to disrupt 20% of global seaborne oil trade. You just need enough uncertainty to make underwriters nervous. Here is what I think markets have already priced: a $3 to $5 war premium on crude, a modest risk-off rotation in equities, a flight to treasuries and gold on Monday morning, some widening in credit spreads, particularly in emerging market sovereigns with energy import exposure. Here is what I believe is not yet priced: the possibility that this operation extends beyond 1 week, the probability that shipping disruption in the Gulf persists even without a formal strait closure, the knock-on effect on global liquefied natural gas flows, given that Qatar's entire LNG export capacity transits the Hormuz corridor, and the interaction between this supply shock and an inflation backdrop that was already deteriorating before a single missile was fired. Friday's core PCE came in at 0.5% month-over-month, well above the 0.2 consensus. Core PPI printed at 0.8, nearly triple expectations. The Fed was already boxed in. A sustained energy price spike does not give them room, it takes room away. My base case is this: oil opens Sunday evening somewhere between $77 and $82 on Brent, depending on overnight news flow about the strait. Equity futures gap lower on the open, with the S&P 500 declining roughly 1 to 2% on the open. Defense stocks outperform, airlines and shipping-exposed names underperform. The 10-year Treasury yield drops initially on the flight to safety bid, but the curve steepens over the following week as the market begins pricing higher energy pass-through into inflation expectations. Gold pushes above its recent range. The dollar strengthens modestly as a hedge, but the move is limited because this conflict directly involves the United States. Now here is the trade-off matrix. In the base case, this is a multi-day military operation. The strait stays open but contested. Oil settles in the mid-70s to low 80s. Equity markets reprice risk premia by 1 to 3%. The Fed stays on hold through the summer. Positioning favors energy longs, defense names, and short duration in fixed income. The key anchor here is that Gulf spare capacity is sufficient and the U.S. Navy keeps the strait functional. In the bull case for risk assets, and I want to be clear, this requires a very specific sequence, Iran's foreign minister has already indicated willingness to talk if strikes stop. If a ceasefire materializes within 72 hours and credible de-escalation signals emerge, the war premium unwinds rapidly. Oil falls back towards 70, equities recover the gap. This is a lower probability outcome, given the stated regime change objective, but it is not zero. Arakchi's NBC interview is the single most important diplomatic signal to monitor. In the bear case, Iran attempts to mine or otherwise obstruct the Strait of Hormuz. Shipping effectively halts. Oil spikes towards $100 or beyond. Lombard Odier has modeled this scenario. Global LNG prices surge. Inflation expectations become unanchored across developed markets. The Fed faces an impossible choice between fighting inflation and supporting growth through a supply shock. Equity markets decline 5 to 10% over the following weeks. Emerging market currencies with current account deficits come under severe pressure. This is a tail risk, but it is no longer a distant tail. It is proximate. One additional variable to watch: OPEC Plus meets tomorrow, March 1st. Before the strikes, the group was reportedly considering a production increase of 137,000 barrels per day for April. That discussion has now changed entirely. If OPEC Plus signals it will accelerate spare capacity deployment to replace disrupted Iranian supply, it provides a partial floor under global inventories. If the group hesitates, it signals that even the producers closest to the situation are uncertain about the operational environment in the Gulf. Here is what to watch in the next 48 hours. Number 1, the Strait of Hormuz. Any reports of mines, naval skirmishes, or shipping route advisories being upgraded from caution to avoidance. This is the single most important variable for global energy pricing, and by extension for equity and fixed income markets worldwide. Number 2, the OPEC Plus communiqué tomorrow. Not the headline production number, the language around contingency planning and the willingness of Saudi Arabia and the UAE to provide explicit supply guarantees. If the strait remains